When you check the lost value of your investment account, it's easy to feel scared and upset. But before you panic, here are 8 things you need to know about a stock market correction. Hi, I'm Marissa with Dollar Sprout. We make videos to help you earn, manage, and save money. So if you want to learn more about all things money, definitely subscribe to our channel so you won't miss a new video. No one likes to hear the term stock market correction. I mean, after all, we just want to see the value of our investments continue to go up and up. But stock market corrections are actually a common occurrence. A stock market correction is when any security or market index drops at least 10% from a recent high. And it's interesting to note that these occurrences are relatively common. Stock market trends naturally fluctuate over time. When the market's up, people are happy. But when the value goes down, fear and anxiety can set in for investors. Often, this is merely a correction in the market, and there's no reason to panic. Depending on your risk tolerance, you might feel mildly uncomfortable or on the verge of a panic attack when a stock market correction occurs. But the stock market is expected to drop. A correction in price following a short-term rise isn't so much a loss in value as it is a market's return to stability. If you're new to stock market investing, these abrupt highs and lows can cause you to worry, but corrections are an unavoidable part of investing. During a market correction, there's nothing you can do to stop it from happening. Instead of attempting to time the market, remember these 8 things the next time the stock market drops. Number 1, stock market corrections are a common thing. Keep in mind that stock market corrections are common. They happen fairly often as markets rise and fall over time. One study has shown that corrections of 10% or more occur every 357 trading days, or roughly every 1.5 years. And according to the market analytics research firm Yardney Research, the S&P 500 index has tolerated 37 corrections since 1950. Though they've been intermittent since the Great Recession, the last 2 stock market corrections occurred in 2018, once in February and again in October. With this information, you can see the stock market doesn't follow averages, which only reinforces that stock market corrections aren't necessarily a cause for concern. Number 2, they're usually driven by emotion. A stock market correction typically follows a recent increase in value, and it's usually driven by emotion. When you think prices are going to rise, there's an anticipation of perceived gains, and you buy more stock hoping to make more money, but others do the same. And the expected increase ignites excitement that drives the price up as more investors buy into the trend. The buying of stock eventually slows and the price begins to fall as you and other investors start selling your shares to lock in your gains. This buying and selling based on perceived gains and losses is the emotion that drives a stock market correction. But it isn't necessarily a loss in value, but rather the decline indicates the stock is returning to its true market value, bringing stability back to the market. Number 3, a stock market correction typically doesn't last long. Watching your investment portfolio drop doesn't feel great. In fact, it feels more like a kick to the gut. But when you're in a stock market correction, remind yourself that it won't last long. Looking at the corrections the market has seen since 1950, 61% lasted 104 or fewer days. There is a potential for short-term losses during these often brief periods of corrections, but the market leans towards stability. Number 4, stock market corrections are difficult to predict. Analysts can add up the number of stock market corrections and arrive at an average to get an idea of how often they occur. However, the market doesn't adhere to the law of averages. The reality is that you can't predict when a correction will happen. In an attempt to protect yourself against potential losses, you can try and analyze and forecast when there might be a correction. But even the best technical analysis of market averages doesn't provide a clear picture of market expectations. Number 5, we only know causes after the market drops. The market can fall for many reasons, including a weakening economy, the emotional response of investors and their perceptions, or the fear of loss. You may see signs in news and in rumors on how the market will move, and sometimes the evidence can point to some political and economical elements. Many factors have the potential to cause a drop in the market, and no one can ever know what the market will do until after it happens. While you can speculate, there are too many components to know what causes a correction until after the stock market drops. Number 6, they're not impactful in the long run. Just like a speed bump, a stock market correction has little impact on your route in the long run. You might feel the bump, but you resist the urge to panic and keep accelerating forward on your journey. Though it won't have much of an effect on your long-term investments, short-term traders tend to be more driven by their emotions. These knee-jerk reactions can cause significant loss during a correction period. Long-term investors, on the other hand, can use this as an excellent opportunity to reassess their portfolio. As you review each of your investments, ask yourself why you bought the stock in the first place. If the reason is still valid today, it's probably best to keep holding on to it. Otherwise, you may want to consider if you will benefit from selling. Number 7, when the stock market drops, it's a good time to invest. The reduction in price during a correction period can give you an opportunity to add investments from high-quality companies. Trying to time the market is rarely a good idea, but you can use this fall in value to buy stocks that might have otherwise been too expensive. To best prepare for a stock market correction, learn enough in advance about the companies you might want to invest in. Then when the time comes, you can load up at a lower price. History has shown the potential is more significant for higher returns just after a stock market correction. You don't have a crystal ball to predict when it might happen, but you can be ready to jump in and boost the overall performance of your portfolio when it does. Number 8, dividends and value stocks tend to be best. If you want to build a more resilient portfolio, dividend and value stocks tend to perform the best during an economic slowdown. That's because high-quality dividend and value stocks will generally lose their worth at a slower pace than growth stocks. A stock market correction is an excellent time to seek out the best value stocks, and you'll want to look for ones with a history of strong earnings and solid balance sheets. During the time of a stock market correction, it's important to remember not to panic. Most sound investment plans are designed to endure market volatility and perform according to the appropriate risk level of your portfolio. Since they are difficult to predict, if you have a long-term investment strategy, sometimes the best reaction is to stay the course. While stock market corrections happen reasonably often, they typically don't last long. Though it can feel like a shock, history has proven that the market eventually recovers from corrections, and they generally aren't a cause for alarm. So if you want to learn more about investing and managing money, don't forget to subscribe to the Dollar Sprout YouTube channel for more money videos, and check out our blog post down below for more on investing. And check out this video here on making money, and I'll see you over there.